market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So European stocks retreating from a record high. Again, traders positioning for this data-intensive week. Now, joining us now, Ursula Marchioni, Head of Investment and Portfolio Solutions for EMEA at BlackRock. Also with us, Justina Lee from MLIV. So thank you both for joining us. Welcome to September. That's gone very fast. And I think we're looking at data. September hasn't been the best month overall for equities. I mean, some of the dynamics here could differ.
Definitely. So September is back to school and historically hasn't been, one of the best months. But you're right, Francine. I think we're looking at a return after a very busy summer. If we think about end of July, beginning of August, everything that happens there. I think there's like a benign element of the equation coming back in terms of, if I look at ETP flows, we haven't seen clients moving away or being scared by what happened. I think another element there is like within the risk on that has remained as a theme, there's been a shift towards maybe more defensive, quality cyclicals, but again, equities have still collected the majority of the attention. At the same time, I think it would be wrong to sweep under the carpet what has happened in the sense that the velocity and the magnitude of the changes that we saw there have, impressed, a lasting impression in clients. I think everybody moves into the end of Q3, the beginning of Q4 with a expectation or some form of like anxiety around other volatility bout. And I'm hearing more and more the idea of positional chess coming through in terms of multi-asset investing.
Okay, so we'll talk about that in a second. But there is that fear or that anxiousness after the huge sell-off that we saw in August that then we kind of recouped. I guess there's a little bit of anxiousness today, just, when it comes to China because of that data.
Yeah, I mean, we got kind of a few sets of bad data here. On one hand, it seems like the manufacturing really isn't turning around. And kind of on the other hand, I mean, new home sales of a lot of the biggest property developers are still down quite a lot from a year ago. And I think, there are a few kind of concerns on the horizon here, right? Because China kind of this year has really relied on demand for its products. But if we do have a bit of a growth slowdown in the U.S., as we're already starting to see in Europe, I mean, what does that mean for that part of, the Chinese growth engine? And at the same time, it doesn't seem like Chinese consumer demand is turning around just yet. And that is very much tied to the property market.
What happens, Justina, in terms of some of the policymakers and what we've been expecting was a big bazooka? Is there a structural problem with China that could also lead to deflation worldwide?
Yeah, I think that's one of the big issues here. I mean, if we think about the real estate sector there, I mean, for years they were building a lot, and now we have the demographic trend kind of turning against that. But I think, one good thing about knowing that the Fed is probably going to start cutting rates is that it does give China kind of some room to also keep cutting rates. And so a lot of economists are expecting more rate cuts this year and possibly more policy support in terms of the property market.
So, Ursula, what do you do with all of these assets? Again, the only silver spot, I think, in that huge, massive sell-off that we saw early August was that finally bonds behaved in the way that they should have been, that we hadn't seen them do over the last couple of years.
100%. We saw the power of diversification and ballast coming back, which was a relief. But you're right. It is a interesting, equation as we come back. We prepare for the year-end rebalancing. And I agree in terms of the interconnections and the attention to China being one of the many elements. So I guess the secret is in this concept of adapting to a new investment world that isn't the great moderation, is embracing the opportunities that we have in an environment where there isn't one clear set scenario that is going to play out. And that is, from a behavioral perspective, a big change for many of us, for many investors, in terms of moving away from the idea of I'm going to position my multi-asset portfolio, my chessboard for a scenario that I believe particularly likely, or I'm going to try to seize a particular moment, a particular trade. This is more, again, we were chatting about it with Pierre Sarroz, our global co-head of multi-asset, is around really this logic of positional chess. So being ready for whatever can be thrown at you. There'll be opportunities, you can pounce on them. There'll be areas that will challenge your performance, as we saw earlier on, and so how to defend against that. So the element of diversification, Francine, for me, has been a bit of a fil rouge of the conversations with clients. A lot of people have asked this year, what's the point of diversifying a portfolio with the Mag 7 when, potentially the winner takes it all? We have spectacularly seen it, and so that's where, my view around coming back from the summer and preparing for delivering returns to end clients towards year end is that concept around the positions.
Ursula, how many questions do you field on staying in cash? Because that must be, in these kind of environments where you're trying to troubleshoot, essentially, maybe there is a lot of investor appetite to just stay put.
Yeah, this is definitely a great point. Like, if we look at money market, asset under management, they have somehow stabilized but continue to remain very elevated. And yet, from my perspective, that isn't a long-term way to deliver value to end clients. And so the positive in all of what we are observing is there is breadth in the market. So we're not in 2023, US tech, a monolithic, monodimensional element. We have other options. Again, if I think about across the board from a regional perspective, a lot of discussions around Japan, and you can take different views, but it is an area that remains, from a structural perspective, under-owned. Europe, probably too early to move towards an overweight, but again, we've seen a lot of interest coming back, including from international investors earlier in the year. And then again, sectorial-wise, certainly if I look at the flows in August, tech remained a vast majority, over 7 billion, but we've seen utilities, for example, coming back, or financials, fourth and sixth month, consecutive months of inflows. So there are opportunities out there, Francine.
Justina, when you look at the US, I know there's been a lot of focus, practically all the focus is on tech stocks. When do they start shifting because of the election, the big election November 5th, and on policies on the back of that?
Yeah, that really is the big question here, because for a while the Trump trade was actually to move into some of those small caps and value. But the problem with that is that you kind of need the economic backdrop to be pretty strong, or you kind of need, I guess, certainty that a Trump presidency is going to happen and it's going to he's going to cut taxes and bring about that rotation. And so I think that if we do see a bit more confidence coming in with the U.S. economy, or maybe kind of Trump's odds rising, then there's a potential for that rotation going on, because we saw a little bit of that this summer, but kind of generally that's still pretty under-owned.
I was looking at NVIDIA. It's incredible that, 50% margins are failing to impress some people. So is there, a valuation concern? Is that why we saw at the end of last week quite a lot of positioning in Europe and saying maybe this is the quarter for Europe and European stocks?
Yeah, and again, for me, it really depends on the investment horizon that you're looking at from a portfolio perspective. So that sees the moment vis-a-vis the positional chess. It's clear that AI is a mega force that is going to rewire our economies. And so, again, having exposure there. And again, if I think about our European investors, because of European home bias, that tends to lead to an under-ownership there, presents still opportunities. I fully acknowledge, Francine, I agree with you, what we've seen last week, again, reminds us of the nervousness, the jumpiness, how much attention we now have, not only in relation to macro data, brace for Friday, but also from an earnings perspective.
Justina, anything else you're looking at? There's all the geopolitics. There's, loads of things where we're kind of at boiling point that the market for the moment is missing. But we talked a lot about crypto 2 weeks ago.
Yeah. Speaking of politics, I think kind of Europe is another sort of flashpoint here, and people will be kind of wondering, with the election results over the weekend in Germany, and of course the continued uncertainty in France. I do kind of wonder if that's affecting a bit of the appetite for investing in Europe. And of course, this is just the big, U.S. data week. Everyone's going to be looking at jobs. I think right now investors are in this really comfortable position where they know that rate cut is coming in September. But they're kind of not that worried about the U.S. economy anymore. And so it will be kind of interesting if there is any disappointing data that might change that.
All right. Thank you both for joining us. Justina Lee and Ursula Marchioni from BlackRock stays with us, and we'll delve a little deeper into Europe. Coming up, Germany's far-right party makes big gains in regional elections, but is it enough to take power? That's a question. We'll answer that next. And this is Bloomberg. Welcome back, everyone. Now, Germany's far-right party, the Alternative for Germany, has been blocked from power despite winning Sunday's regional election in Thuringia and coming a close second in neighboring Saxony. Now, let's get more with Bloomberg's Oliver Crook. So, Ali, good morning. Bring us up to speed with exactly what's happened.
Yeah, Francine, so you had two votes over the weekend in both Saxony and Thuringia, and in both of these elections we had a very sort of good showing from the far right but also the far left. Both have done very well in these two regions, and these are regions that used to be under the GDR communist rule and tend to go a bit more for the political extremes than the average across Germany. Why it's significant, particularly in Thuringia, is because it's the first time that the AfD has come first in such an election. It is the first time a far-right party has come, had that kind of showing since the Second World War, and a place in a region that has historically been sort of sympathetic. It was one of the regions that sort of voted for the Nazis very early on, and its leader, the different chapters of AfD, the two chapters on the ballot this weekend, both in Saxony and Thuringia, have been designated extremist political organizations by German intelligence. The leader in Thuringia has been fined twice this year for making speeches and alluding to Nazi salutes. So these sorts of things really have a lot of people in Germany on edge from the political mainstream at a time when obviously the economy is slowing down. There's a lot of anxiety and a lot of people going to either end. And where you saw the real collapse, Francine, was among the support for the coalition government, the SPD, the Greens, the FDP. The FDP, in fact, got so few votes in both regions, they've been knocked out of local parliament, and the same is true of Greens in one of the regions.
Ollie, thanks so much. Bloomberg's Oliver Crook there, joining us, of course, on this pretty spectacular result. Now, let's get more from our guest, Ursula Marchioni, Head of Investment and Portfolio Solutions for EMEA at BlackRock. Ursula, thank you so much for sticking around. It's unclear, first of all, and, you know, we can't really talk politics, but when you look at, I guess, the vote, is it the economy, is it immigration? Because that will change policies, and so we'll be left with economies that could look radically different to what we have now in Europe.
100%, and I think there's a theme there in 2024, right? We have seen a number of election spiking, and obviously we're bracing up for later in the year to the big one in the US. So I agree with you. This goes back to this idea of, it's a bit of a funny word, but polyfurcated scenarios for investors in terms of exogenous factors such as the political ones and therefore decisions on trade, on immigration, on tariffs that can really shape things in a material manner, in a manner that actually didn't used to be the case throughout the Great Moderation. So there's certainly a theme, and that's what brings what sparks to mind in terms of what we have seen over the weekend, in terms of going back to portfolios and again thinking about that element of what would happen if, whereby the likelihood of one specific scenario has decreased, and this idea of a multiplicity that we need to prepare for has come back. Again, not an easy job for a multi-asset investor. The flip side and the silver lining there is that we continue to see breadth coming through into the market. So if I look at earnings, for example, I found the US results extremely fascinating. We have seen an 8% EPS growth rate. But again, it isn't tech that is driving anymore. Healthcare was actually the best at 17%. So you start to see that element. Only one sector out of all of them didn't deliver positive results. In EMEA, the situation in Europe, the situation is a little bit more nuanced. We still have half of the sectors that are in negative territory, but again, that initial breath is coming through. And so again, towards this range of outcomes and greater probability of bouts of volatility as we saw throughout the summer, I think there's a lot of positive elements to embrace in terms of that opportunity for diversification.
But so Ursula, does it mean that, for example, you stay away from sovereign bonds because that's, I guess, more risky depending on the politics, and focus more on some of the industries and a breakdown such as defense? Is there a way to basically try to ignore the politics?
I think it will be more difficult to ignore the politics than what it was before. Although from a fixed income perspective, I will be nuanced there as well. So if I think at flows in August and looking at how investors have voted with their feet, that theme of more defensiveness, potentially, quality cyclical being picked that we saw on the equity front translated into fixed income, where we saw rates being the leading force and investment grade as a result, very subdued actions and activity in terms of emerging market debt and high yield. So again, certainly rates are coming, and obviously we are prepping for next week and the week after, where we're going to see, action. But at the same time, those are well-telegraphed, gentle paths, which are not going to bring us back to the lower bound that we have been investing into for the great moderation. And so the idea of locking in yield is still very powerful in our portfolio.
So interesting. Thank you so much, Ursula Marchioni there from BlackRock. We did a nice 360 view of the world. Coming up, the UK's private equity industry weighs in on the government's tax plan. So we'll have the details next. And this is Bloomberg. Now, the UK's private equity industry has offered to support some of the government's proposed plan to remove a tax break. Jenny Serrain, our UK finance team leader, now joins us. So, Jenny, thank you so much for being here. What does the government, what are they actually talking about doing, and why are private equity firms so worried about it?
So there's a lot of different options on the table, but I think the one that the PE industry is probably the most worried about is the idea that the government's planning to remove a decades-old tax break that they offered to different deal makers unless they start to invest in funds themselves. And so you've seen that cause a lot of angst over the last few months. And over the weekend, we heard finally from the industry kind of in response to this, and after the government asked for the industry to give their views, we finally kind of heard from them really kind of taking a deep dive into what the government is proposing here. And I think what was actually sort of surprising about what we heard over the weekend was that the industry said, you know, as long as this doesn't apply retroactively, as long as this only applies to kind of funds that we create going forward, this actually could work. There was lots of qualifiers, lots of, not wanting to fully support any measures, but it sounds like they're kind of warming up to the idea that this is in the works and trying to figure out a way to work through it.
So, Jenny, do you think private equity firms have just gotten used to the idea, or they're trying to help the government to try and get the best possible outcome?
I think it's a little bit of both. We've heard over and over again from Labour that they are planning to roll back some of these different tax breaks. I think the way Keir Starmer put it last week was the biggest burden will fall on those with the widest shoulders. So I think they know something's coming, and now their tactic is really, okay, so within that understanding, how can we kind of make this work for us? I think one of the things that they raise a lot is London's attractiveness as a financial center, which is a very, a wise move, because I think we hear so much from Labour, from Keir Starmer, from Rachel Reeves, that's really one of their primary concerns. And so you kind of see them, using that as almost a tactic to try to get the government to really listen to what they're trying to say.
So is there a real danger that a lot of these firms actually move to Dubai or Milan or elsewhere?
That's the fear. I think it's still too early to tell, how likely or realistic that really is. But it's definitely something that these firms have warned will happen. And you've seen a little bit of movement, but, I think as these proposals actually become law and kind of actually roll through the system, you'll kind of see folks decide, was this a big enough break to make it worth staying in London? Or will I kind of go to cheaper pastures, as it were?
Jenny, thank you so much, as always, for the terrific roundup on the latest, of course, private equity and the new government. Jenny Serrain, Bloomberg UK finance team leader. Now, coming up, nationwide strikes across Israel, with thousands expected to take the streets today, demanding the government does more to bring the hostages back home. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. After 4 months of gains, global equities begin September on the back foot, with weak manufacturing data out of China. Israel braces for a nationwide union strike as anger grows over Prime Minister Netanyahu's handling of the hostage crisis and a possible ceasefire deal with Hamas. And Germany's ruling coalition is punished in 2 regional elections in the east coast of the country, with the AfD on course to become the first far-right party to win a German state ballot since the Second World War. Now, on to Israel's largest labor group, and it's poised for a nationwide strike today, despite the Israeli government asking for a temporary injunction against it. Now, the strike will be the strongest push yet to force Prime Minister Benjamin Netanyahu's government into a ceasefire deal in Gaza. This after a large protest over the weekend following the discovery of the bodies of 6 hostages in a tunnel in the Gaza Strip. We're now joined by Ross Matheson, our EMEA news director. Ross, thank you so much for joining us. It does seem like the government injunction will fail, which is another blow for Netanyahu.
Well, what we're seeing, of course, is there's actually industrial action already underway in Israel. We've seen flights disrupted for some hours. This morning we've seen civil servants protesting, government offices closing, for example, schools as well. So we're starting to see the beginnings of this industrial action. The question is, how long does it go for? Does it continue to be nationwide for a matter of days, weeks or whatever? Does it peter out pretty quickly? But given the protests we saw yesterday and again today, kind of reminiscent of those anti-Netanyahu protests we saw before the October 7 Hamas attack against his government, his administration, there's obviously a deep well of disquiet at his leadership, both when the attacks happened, but also since, and frustration that there cannot be a ceasefire agreed, because this war has obviously been devastating for Gaza, but it's also hit the Israeli economy. For example, there's been no great progress in getting these hostages back alive. What it means in terms of forcing his hand, that's a bit hard to say, because he seems quite determined to continue on the path he's on, which is, to hold fast to his demands, what he says has to happen to get a ceasefire. So will he break on this? It's a bit unlikely.
So what are the chances of a ceasefire at this point?
Well, they also remain unlikely because they're just stuck on their various sticking points about it. He's adamant that he has to have control militarily of this small strip of land, which is really the conduit between Gaza and Egypt. He says Hamas is using that to funnel weapons and personnel in and out, and then possibly to use that as a launch pad against Israel. So he's insisting on that. But the broader question of what does a ceasefire do? Is it the pathway to the end of the war? Is it just a pause in the fighting? So a lot of sticking points, time running out, the US starting to throw its hands in the air and saying, we can't get anywhere. We're running into our own election cycle here in the US. Also, you're going to have to help yourselves at some point. But it doesn't seem like he has the impetus to force an agreement.
But there's does he stay in power? Or is this a question for 2025 and beyond?
Well, he's really pushed those questions, further into the future with this war that's been going on. There were big questions about his leadership before the war happened. There have been protests throughout about his handling of it. Certainly a disquiet with his leadership. Not necessarily people oppose the war, but they're, about his leadership. And obviously, there's long-running legal cases that are still going on against him. I mean, popular protests have failed to dislodge him so far, and they've been pretty sizable. Do they now get traction, or is it really the legal cases at some point? But once this does all start to slow down, including the war, all those questions about his leadership are definitely going to come back to the front of the conversation in Israel.
Roz, we're just getting a couple of headlines. Hamas has claimed a shooting which killed 3 police officers on Sunday. They've also claimed double car bombing in the West Bank over the weekend. Is there still a really deep fear of escalation?
Well, that is the concern also in Israel. Israelis are saying we've been braced for weeks for some kind of retaliation from Iran for that strike. And remember, that took out the senior Hamas official in Iran. This seems to be spreading further into the West Bank. We've got daily skirmishes into Lebanon against Hezbollah. Is this spreading? Is it going to escalate? But even if it doesn't turn into a full regional war, which no one seems to want, it's just taking up a lot of time and energy, resources, manpower for Israel, and people inside Israel feeling they're living all the time with the threat of some kind of major action. And so their concern is that, it doesn't have to spiral into a full regional war. Is it just going to spread to the point that it wears Israel down?
Ross, thanks so much. As always, Ross Matheson, there, of course, our news director for EMEA on the very latest in Israel. Now, switching focus to France, and President Emmanuel Macron is set to hold talks with senior political figures as he prepares to name a new prime minister. Now, he'll be speaking with the former socialist Bernard Cazeneuve. He also plans discussions with conservative Xavier Bertrand today. Well, joining us now is Jeremy Ghez. He's professor of economics and international affairs at HEC Paris. Jeremy, great to speak to you. I know you've helped us understand multiple elections over many, many years. Why is there such a big delay? We were expecting a name over the weekend. Why is there such a big delay in actually naming a prime minister?
Yeah, I think that's a question many Frenchmen and French women are asking themselves today, to be honest. I think there are 3 overarching objectives that are incredibly hard to fulfill. The first one is getting a prime minister that is censure-proof, one that would create some form of consensus or basically allow a majority of members of the National Assembly not to censure the government. That has proven hard. Number two, I think the ghosts of the experience of Liz Truss are all around Paris right now. Macron did not want to go with a dangerous pick that would create a lot of tensions on the markets. And it seems that this is a risk that is in the mind of the French president and in the mind of many of his advisors. And the third objective is trying to get a pick that will shape the Macron legacy and one that will not completely undermine it. And it seems that finding the right candidate for these three objectives, fulfilling these three objectives, is a very, very challenging task in the Élysée Palace right now.
Jamie, is there a danger that actually whoever's appointed will then have a no confidence vote, and by whom?
Right. No, absolutely. And being able to go beyond that no confidence vote is proving to be far more difficult than it was in the past. So it was crystal clear that, for instance, if the government would have included ministers from La France Insoumise, so the far left chunk of that socialist coalition, of that left-wing coalition, a lot of other deputies, members of National Assembly, would have voted for the censure. And it is also clear, I think, to President Macron that this was a non-starter and that he did not want to hear it. So finding that consensus is incredibly hard, especially that we're kind of in a no man's land in France right now, because this is a situation of a fragmented parliament that requires coalition building. And truth be told, it's not really what the French have been used to. French political class has been used to in the past. So this is basically learning by doing. I think there was a parenthesis with the Olympic Games, and now it's really a challenge of getting the things done.
Jamie, is the biggest concern actually, social strife and the fact that we could see a lot of, the kind of paralyzed France because people don't go to work, or is a bigger concern actually this budget coming up in October?
Yeah, I think it's a little bit of both. I think you have to understand French society as being at a point at which, it's not crystal clear what the solutions are. And I think this requires a lot of pedagogy. It requires a lot of communication in a society that is very tensed. So yes, the social part of this is very important. But as you say, the budget part is important too, because I think that the experience of past European countries, the UK being one, is one that Macron wants to avoid at all costs. So it's trying to build a coalition, a new brand coalition that will preserve Macron's legacy, but that will also be meaningful going down the line. This is not going to be an easy task because you're going to have to convince a wide range of stakeholders, ranging from the French population, the labor unions, and the French workers in general, to financial markets, to, I guess, the broader political class, trying to steer this country towards reform and towards a very hospitable business environment that I think is a goal that Macron and a wide range of actors, political actors, have today.
So, Jamie, given all of this context, how difficult is it going to reassure Brussels that they will be on the path for fiscal, because of the excessive deficit procedure by the EU, that they will remain on that fiscal path?
This is a striking question, yes, because to be honest, it hasn't been part of the public debate in France right now. This is an ongoing mechanism happening in Brussels right now. The fact of the matter is, the real debate is a very political one right now. I think that what Macron probably has in mind today is that if he's able to give new momentum to this political life in France with a new government, then that will he may want to wish it away, or at least buy himself some time, buy France some time on that front. The real question is, how credible can this be, and how credible is this figure going to come out, trying to convince a wide range of stakeholders, again, very different, ranging from the French population to financial markets, and as you say, to Brussels, trying to convince them that this is the right path. This is going to be a confidence-building measure over time, and we're really going through an unprecedented period.
Jamie, thank you so much for joining us. Jamie Ghez, professor of economics and international affairs at HEC Paris. Now, coming up, Rightmove shares surge after Rupert Murdoch's REA Group confirms it's considering making an offer for the online property portal. More on that next. And this is Bloomberg.
On September 10th, as Election Day approaches, Vice President Harris and former President Trump hit the stage for the first time.
Oh, we're going to beat her. I look forward to the debate.
If you got something to say it to my face.
We'll bring you informative analysis.
Will that debate decide the outcome of this election?
It's going to come down to both policy and performance.
Tune in to Bloomberg Television for the ABC News presidential debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
Now, shares of Rightmove are surging this morning on news that Rupert Murdoch's REA Group is considering a $5.8 billion takeover offer for the UK property portal. Now, REA said it could make a possible cash and share offer, but no firm bid had been made so far. Let's bring Bloomberg's Marwena Konyam now with the very latest. I mean, I couldn't believe it, Marwena. I had to look like 2-3 times. What makes Rightmove so attractive?
Well, it does actually have 80% market share of UK property listings. And the UK property market is showing signs of warming up. So there are expected to be more transactions. We've seen more transactions. And with the prospect of another Bank of England rate cut on the horizon in probably November, then, things are expected to keep moving. And it's also just something that the Australian company, they want to expand their global footprint. And Rightmove is seen as a good opportunity to do that.
So, I mean, the reaction is pretty starking when you look at shareholders. Rightmove is gaining, I think, some 20%. Is this to also unlock and do a kind of global platform? And what does it look like?
Yeah, so it's not going down too well in Australia, actually. Shares of REA were down because they see that actually they'd have to offer quite a substantial premium and actually require an equity raise in order to be able to make it an accretive deal. The question is really how much that premium is going to be, and analysts are mixed over on the UK side as to whether it's got Citigroup saying actually they're not going to pay more than 30% premium. You've got other analysts saying actually it's worth a bit more than that. The shares have been a bit discounted, a bit depressed, as has a lot of the UK market, but things are hotting up. This is more attractive than perhaps it seems, and shareholders are pretty happy with a consistent sort of steady share price. So there is going to have to be a bit of give and take there.
Marwena, thank you so much. Marwena Konyam there with the very latest on Rightmove. Now, the UK's Parliament resumes today as the Prime Minister warns of, quote, painful measures to fix Britain's public finances. Now, some senior Labour politicians have told us they're concerned about the government's gloomy messaging. Well, Phil Aldrich, Bloomberg's senior economics reporter, joins us now. Phil, we were just talking about this. First of all, good morning. The fact that it does seem like Keir Starmer and his team are going out of their way and saying, like, look, blame the previous government for this dire state of public finances. How difficult will this budget actually be?
Well, it looks like it's shaping up to be a pretty nasty budget, right? The public finances have underperformed and the economy has overperformed. Normally, if the economy overperforms, you'd expect more revenues to be raised, so life to be getting easier. So there is a disconnect there. So clearly, the implications are that more money is going to have to be found regardless. And obviously, Labour wants to sort of kitchen sink some of the problems at the start of, as every new government does, to the start of their term. And then it's about blame shifting. So if they can move the blame onto the terrible inheritance as they're claiming that they've got, then they can rest the problem with the former Conservative government. I mean, and obviously the more taxes you raise earlier on, the more, if things do improve, later down the track, closer to the next election, they can start cutting those taxes and they start to look like they've both repaired the public finances, the economy's doing better, and they're able to give people money back, as it were.
So, we seem to have a pretty clear idea, actually, of what's in the budget. It could be inheritance tax. I know private equity have been trying to lobby the government on certain aspects, but it looks like they'll, slam a lot of finance. Do you have a clear idea of what's in the budget coming up October 30th?
No, nobody really has a clear idea. Obviously, there's the non-dom and private equity carried interest tax and the VAT on private schools. Those were in the manifesto. Beyond that, everything is, we have no plans to raise taxes here or there, is what they say. Obviously, that's what they did say. Now they're just keeping stum. So it does look like the likely ones are going to be some reform of capital gains tax, potentially, that can raise some money. Then tinkering around, inheritance tax. So they're sort of going after pockets of wealth, because rather than income, income has obviously seen quite hefty increases in the tax rate, particularly because of the frozen tax thresholds for 6 years, and also the top rate of the highest, 45p rate was lowered from 150,000 to 125,000. So you can see that they would like to target wealth rather than income.
And so does that mean, will they be very mindful in making sure that people don't actually leave the country, so that it's not too punishing, so that business or even private equity is not relocating? Yeah,
that is the big issue. So the sort of disconnect is where Keir Starmer talks about we want to be supportive of the wealth creators, and at the same time their actions are suggesting that they're not. All of the taxes or policies that were in the manifesto, carried interest, VAT on private schools, the non-dom stuff, all of that is discouraging for deal makers, people in the city, private equity people who make a lot of money. But it looks like there's going to be some kind of carve out in the PE rules. If you put your own capital at risk, you may get some exemption. Obviously, the vast majority of people in the PE world don't have the money to put the capital at risk, but it'll be good for the big bosses, the big deal makers.
Phil, I know there's this talk about the fact that it's downplaying or making that it's going to be a difficult budget. Is there a danger that actually the OBR comes out and saying you'll have to find more money than we think? Well,
yeah. So the first iteration of their forecast, which is privately delivered to the government, to Treasury, is on September the 19th. Now, we could start to see leaks coming out. Under Jeremy Hunt, those leaks were very leaky. It was a total colander as far as what we could learn from the former Chancellor. So but that September 19th will be key to really shaping the narrative. So if the narrative gets even more bleak, you could basically interpret from that the OBR has said there is less money than you thought available. So you're going to have to do some more painful things. But there are tricks that they can do. They can change the debt rule within the public sector debt fiscal rule. There's also fiddling around with Bank of England interest on reserves, the QE portfolio. So there are sort of very technical things they can do which can save a lot of money. Nobody would really understand them apart from obviously Bloomberg viewers. So there are ways to claw back some money without raising taxes, to the extreme.
Okay, so interesting. We'll have plenty more, of course, of Phil Aldrich throughout the next couple of weeks until October 30th, right? That's the big day for the budget.
That's the big day, yeah.
There you go. Phil Aldrich, Bloomberg senior economics reporter. Now, coming up, it's September 2nd to be precise. Traders positioning themselves for a potential volatile month. So we'll preview what to expect. That's next, and this is Bloomberg. Now, traders are starting the new month awaiting crucial data from the U.S. and Europe that could inform monetary policies for global central banks. Sven Ram, Bloomberg MLIV strategist, joins us now. So, Sven, good morning. How are the markets actually positioned ahead of the jobs data?
Good morning, Francine. I think that the rates market are positioned fairly bullishly ahead of this week's data. If you look at the OAS markets, the markets are thinking there's going to be 4 rate cuts between now and the end of the year, and as many as 9 rate cuts by the end of next year. So that's a lot that the markets are pricing in. For the markets to be proven right, I think that the employment data will be crucial, and if the jobless rate number If it pushes above 4.3%, there's a good chance that the Fed may want to shoehorn in bigger rate cuts than in line with what the market's expecting. If, however, that number shows a moderation, I think that the Fed will want to take it in a measured sequence, i.e. in 25 basis point cuts. So there is room for correction in the Fed funds rate, the way the markets are positioning. So overall, it's a very bullish market. I mean, the Treasury 2-year yield is below 4%. So there is room for correction if the data proves to be, shows that the economy is still holding in pretty decent shape.
Can the U.S. equity markets continue to keep surging?
It's a fairly bullish scenario for that to happen, Francine, because if you look at the markets, if you look at smart money investors, like Warren Buffett, they've been taking money off the table. And these are stocks in which they've been locked into for years. For instance, Apple, Bank of America. It's not as though Warren Buffett has had a moment of apostasy thinking, these stocks are no longer good. It's about valuations, and those valuations are stretched. And if you look at the yield curve, the 2-stance yield curve is kind of about to disinvert. And that typically happens when the economy is already tipping into a recession. So I think that, investors need to be cautious here.
Yeah, so interesting. Ven, thank you so much, as always, for your terrific insight. Ven Ram, Bloomberg MLIV strategist. Now, Bloomberg Markets, that's ahead, and this is a Bloomberg.